I always like to start off the show with kind of a summary about what I saw happening this week in the stock market. Um, and the main question I want to answer actually came from a comment from yesterday's video from Adam, one of our viewers. And wanted to know if we were going to increase our exposure back into the stock market because of the different things that had happened, especially the positive things that had happened this week. And so I'll answer that in some detail here because I think it's a really good question. As you know, we were at 63% stock across the board with all of our clients on average, and we've dropped that down to 22% stock. And really, the rest has gone back into T-bills and ultra short-term bonds and things like that, where we kind of wait through all of this. Um, and so I'll start with, just a conversation about tariffs itself. Okay. I've done more research and learning on tariffs than I've ever done in my life. And because of all this, spent a lot of time trying to see, do tariffs work? I mean, because we've seen, all of these different stories and different things, but do tariffs work or do they not work? Okay,
Mhm.
kind of start there. Uh, and if they do work, why? And if they don't, why? So tariffs actually were pretty effective for certain situations, especially for kind of new industries or even new countries. We had in 1816, Alexander Hamilton had a tariff to kind of protect, the U.S. from British goods that were coming through, and that was seen as a success. And then the early years, the late 1800s of the U.S. steel industry, we had tariffs to protect that industry as it developed. And it turned out that we became one of the leaders in steel production,
Mhm.
and were able to exceed, what the British were able to do and what have you as far as that goes. South Korea has, tariffs that they put in the 60s and 80s to protect, their electronics industry and their, automobile industry. And out of that, they got Samsung and Hyundai, right? So there are situations where we've seen where it's worked as far as that goes. And then obviously we've got all these other scenarios where it hasn't worked.
Mhm.
We talked about Smoot-Hawley the last time, which was a tariff that was put into place to try to create American jobs
Mhm.
and lessen unemployment. It backfired dramatically, mainly because there was so many retaliatory tariffs, which is kind of what we're getting today.
Yeah, and those industries that you talked about how the tariffs were, it felt like the tariffs were very targeted to a certain industry or a certain spectrum. They weren't broad. Like Smooth Holly was quite broad, while this is very much a kind of like a scalpel, right? You're picking an industry that you want to protect and grow.
Yeah, which would be normal, doing this broad-based thing, basically almost on everything, with a few carve-outs here and there. So in summary, looking at all the things that I've been looking at, even the 2018 tariffs that were put into place by Trump's, during Trump's first administration, you look back and you can see that, it raised the price of those pieces. There was more job losses in total than there were job gains in those industries. And even companies that made everything domestically were still raising their prices, because if your foreign competitors are now having to have a more expensive cost because of this tariff, all of a sudden you got this room you could move up to match those or be just below those foreign competitors. It gives you more margin to work with as far as that goes. So not a terrible thing for that industry or for that company or whoever it's dealing with, but as a consumer, it's a problem. And of course, two-thirds of the U.S. economy is a consumer,
Mhm.
based issue, and so the more that we kind of pick on the consumers, the more potential you have for big recessions and even depressions as far as that goes, because it's essentially a cycle. If things start to slow down, let's go for example. I mean, we're looking at the ports slowing down here now already. Trucking will slow down. Retail will slow down. That's already going to happen because the shipping has dropped off so much. Now, it might be temporary if they can get things moving fast enough, but we already have that. And so if you start seeing layoffs across all those different types of industries, well, those are people that used to have money to spend that aren't going to be spending as much. And then pretty soon other companies are seeing slowdowns. And so there's this spiral that happens. And you can't really control that spiral except for a couple different ways. You can lower interest rates, okay? But when if tariffs are making prices go up, oof, it's a really brutal thing to try to lower interest rates in that, because you could end up with a hyperinflationary situation like we did in the 70s. The Federal Reserve is very concerned about that. You can do stimulus, right? So you push money out like they did during the pandemic, like they did at the end of 2008. Again, those are both inflationary, potentially also. So you could get into this very weird situation where you have unemployment growing at the same time that prices are going up. That normally doesn't happen because unemployment growing means that there's less demand and prices should come down, but prices are being artificially pushed up by tariffs. That could be an issue as far as that goes. So what I'd like to do is just kind of, I'll show you a couple of things on the chart here. We'll talk about just so you can see where we're at. All right, so this is, the same chart we've been looking at for quite some time now. We can see, actually this week, I think we're maybe going to end up down slightly in the end. We were
Yeah, it was
down
a
Monday.
pretty flat week.
Yeah, I'm down Monday, Tuesday, up Wednesday, Thursday, based on some comments, and we'll talk about that. Um, and I'm going to switch back to the other view because so we can just really kind of concentrate on what we're talking about. So when you have a scenario like we're in now, it it's really fascinating because fundamentally we would be looking at things that drive the stock market, like earnings. Okay,
Hmm.
so but first quarter earnings have been fantastic, 13% higher year over year. We would look at things like retail sales, been really, really good, right? First quarter, very good, right? Um, both of which could be unfortunately attributed towards tariffs. And so everybody's spending more money than they might normally spend trying to buy things and do things before the perceived costs go up, right?
Yeah, because people want to try. Use a car for example. If people think there's going to be, just a tariff on cars, and they're going to need a car in the next year or two, why not just buy now if
Yeah,
they can, if they
e-
have the means to?
exactly. And so what we've now been kind of forced to do is to back away from kind of fundamental analysis, looking at earnings, and really looking at comments, right? Tweets and actions. Okay. So this is what I'm doing on a regular basis, day after day, looking at comments, tweets, and actions, trying to figure out what do they mean? What are the impacts? What do I think the impacts are going to be going forward? So let's take a look at some of those. So first of all, one of the actions that's going to happen that I think is a positive is we're going to have a meeting. The Treasury Secretary and one other, I can't remember his name, are going to meet with their counterparts in Switzerland from China. And so that's a positive development, right? So
Hmm.
that's an action that's happening. That's a positive development. It's the first meeting, even though we were told there's been multiple meetings and multiple conversations under oath. Treasury Secretary said there hasn't been any. So this will be the first one, and I think that's a good sign. It's a good start as far as that goes. We had some comments from Trump about getting taxes higher on people that make a million or more. And the reason that's so important is because we are working on this tax cut bill. And historically, both parties have been guilty of this. They go through what's called a reconciliation process, which is where you only need, a majority of the
Hmm.
Senate to get through, not the 60. We haven't been able to get to 60 on either side for quite a while. And so what that means is that they have to match the cuts in revenue with cuts in overall cost.
Hmm.
And they reconcile that over a 10-year period. Historically, what's happened is they've done that, they've got it through, and it's been wrong. I mean, basically, the it hasn't been neutral. And even sometimes they even ballyhoo it as, oh, this is going to be positive. It has not been positive. Deficits continue to grow. And so the danger of having a reconciliation bill that the market doesn't see as being uh, accurate is that the bond market could start to freak out. And the bond market is the key to all of this. I mean, you cannot pay for deficits without being able to sell your bonds. And if the bond market is struggling, you're going to see the yields on those bonds go up. Matter of fact, we had a 30-year Treasury bond auction this week that I would give us a grade of C. Okay. It wasn't that great. And so it is the key to all this. So if you make the bond market even more nervous by passing a tax cut bill that really doesn't work, and the bond market know it doesn't work, you're going to have problems. And we use the bond market to bail ourselves out. So if these tariffs turn into a big recession or something and we want to do stimulus bills and things along those lines like we did in 2008, like we did in 2020, we're going to have to go back to the bond market. The bond market could be in a weak spot already because of this tax cut bill. And so I thought it was a very positive development to say, okay, let's gather some extra revenue
Hmm.
by putting in a 39.6% bracket on 1 million and above. Right now, the top bracket's 37. So it's 2.6% more. Seems reasonable. It helps to reconcile the overall tax package as far as that goes. Unfortunately, we just heard just before the show start that Trump has backed off on that because of pressure from the GOP. But that is the second time I've heard that. So we'll see if that plays through or not. Um, because the other parts of that, they're talking about modifying that reconciliation. Instead of making the current tax brackets permanent, they would maybe make it for another 5 to 8 years, and then we'd have to sunset and deal with it like we're dealing with now, which again, I think is a more positive development. I'm very nervous that they're going to put together a bill that the bond market hates and
Mhm.
is going to have a meltdown. Now, I will say there are some Republican hardliners, especially in the House, who are really driving this. They will not back a bill that causes this type of problem. So again, I see that as a positive. Those are developments that have been happening this week, right? Those are things that I think are very much so in there. We had Trump talk about yesterday, buy stocks now. We had more than one sentence. There was actually a conversation about why it was going to be a good time to buy stocks. Uh, I think that's a positive development, especially in the short term, because Trump knows more than any of us about what might be happening,
Mhm.
going forward. And so when he says to buy stocks now, at least in a short-term basis, that could be good. Long term, you can say what you want to say if the numbers are all falling apart and the economy's falling apart and unemployment's going up. I mean, this is what I mentioned in my videos this week. The Federal Reserve does this. We call it job owning. They try to basically say things to get things to happen. So they wanted the stock market to stay down in 2022 because that would help them with their inflation fight. So they said a lot of negative things, right? But eventually the numbers started coming through that were showing better and better results, especially on inflation. And it didn't have much impact when they'd say things. The market wouldn't move as much as it would like at the beginning of that whole time frame. And so, again, the actual numbers, we're in this kind of zone right now where we're not seeing the actual numbers. Yeah. So I saw that as a good thing as far as that goes. All right, so here are some of the things that I saw as kind of on the negative side. And so this is how I'm doing it. I'm just kind of parsing out all of this information that's coming in and trying to weigh the totality of the positives versus the negatives as a decision-making point to decide, should we be getting back in with some of this money? And okay, so one of the things that I saw, ironically, as a negative, although it was presented as a positive, was the UK deal.
Mhm.
Okay, so what happened with the UK deal is we stayed at 10%, tariff on all UK imports, and we reduced from 25% down to 10 on their automobiles, their steel. And then I thought the best part of this deal was the fact that we got soybeans, um, meat, and sporting goods, whatever that is, um, all had reduced tariffs by the UK. So in some cases down to zero on exports from the U.S. Okay, so that's good. The problem with that is that our tariff on UK goods was 2.2. So we just more than
Mm.
4 times the cost to what's going to be the consumer or the importer, or somebody's paying that on that. And that we made that quasi permanent in this particular agreement. And worse, we just set an expectation for the rest of the world that 10% is as low as we want to go. And that's significantly higher than we're at right now. And so that's a massive tax that's just been, presented as a good thing for the UK. So
And you have to also remember with the UK, this is a trade surplus nation too, not a
yeah,
trade deficit.
yeah, with a very small 3% of our trade is with the UK. So it's a good test case. It's a good thing. But you look at the precedent and look at what they're talking about there, and it's the idea that I thought and that I was hoping for. We do the 10%. We use that as leverage so we can get down to zero on both sides. Let's have a trade, situation, because when we have 10% on our side, it means the goods that are coming in from the UK that we need or want, whatever that might be, are now 10% more expensive
Hmm.
to somebody, right? So what happened in that deal to me was like, oh, this isn't a concept to try to get to free trade, okay? Which, when you look at the studies that have done inside of tariffs, in today's global world, the best scenarios that have worked out with the best growth have come from free trade or
Mhm.
very low barriers to trade. In the past, maybe we had to protect certain industries or whatever, but that's not what this is about. What this has become about is trying to generate revenue to the country. Well, they're going to generate that revenue from our pockets,
Yeah,
right?
it's $6 billion, I believe, is the estimate.
Is 6 billion is the amount that's being traded, or the amount of the tariff?
The tariff estimate.
Wow. Okay. All right. So that I thought was kind of interesting as far as that goes. Today was a comment about, hey, we're going to go to 80%. I feel like 80% is about the right number for China. A couple things. First of all, as an opening salvo, 80% is fine. As an ending result, it's the same as 145%.
Yeah.
It's too high, right? I've been hearing, maybe it'll get down to 50 or 60%, and some people seem to think that's okay. I'd be really surprised if that
I
didn't
think
have a big impact also.
I think it also depends on, we're used to Chinese the price with Chinese goods coming in, but if it just costs too much to produce here, I think we just have to eat that 50% at that point.
Which just means that there's either decreased profits or decreased pocket money for consumers. It's all I can come up with. It's exactly right. China might eat some of it. Importer might eat some of it. We'd eat some of it. That's that. If you look back at the 2018 tariffs, let's say they were, I'm paraphrasing here, but 10%, and maybe the cost went up about 5, right? So half that tariff got passed through. So if your business needs Chinese goods and you're all of a sudden paying 50, 60% more, um, okay. So, but here's my real issue with this 80%. Okay, I've read The Art of the Deal twice. And there's an excerpt in there about using leverage. And the whole process is to try to get to a position where you're in a position of strength. So, for example, in this particular case with China, if you really wanted to get to a position of strength, you would have gone around to all the other countries in the world, especially the major trading partners, and set up deals and specifically made part of those deals to kind of box China in. And then the art of the deal to me is 145% tariff. Okay, I'm in a position of strength. I've got all these other countries behind me. I'm coming in. You know what it's not? It is not announcing that you're willing to lower the tariff before the meeting even
Mhm.
stops. And you're willing to lower it more than they're already charging, which is 125%. And so, basically he's talking about, he warned against appearing desperate. Okay. That sounded desperate to me. I thought from a pure art of the deal standpoint, he should have just waited to see what happened in that meeting and let that happen behind closed doors. Because if I'm China, I'm sitting on 90% of the, rare earth metal production. I'm sitting on 97% of the antibiotic production, 90% of the other,
Mhm.
production for pharmaceuticals, 80% of the production of toys for the world, and I've got these leverage points. And China just had their export report came out for April. It went up 8%. So they exported 8% more than they did last April, even though the exports to US went down more than
Yeah,
20%.
I wonder if other nations are, rather than importing from the U.S., have switched over to importing from China for certain goods.
Yes. So they're sitting in a position where they're actually generating more money, even with these cuts in production to the US. Now, I'm sure it's not even, right? Some companies are getting hit harder because they're mainly focused on the US and others aren't. But you're talking about a centrally planned economy. And the word is that they start to support those other industries with some of this excess cash flow and such too. So here they are, they're sitting there with more income coming in than they had before these tariff wars start. And they're sitting at 125%. They got all these leverage points. And then their competitor just blinked and said, oh, we'll go to 80%, which is below where we are. Ooh, would you drop? I wouldn't drop. I'd
Yeah,
stay at 125.
China's on the point of control.
Yeah. Yeah, exactly right. I mean, I wouldn't drop. So that I thought that was something that was made me a little nervous. We'll see what happens. Because what happens once we get in a position of weakness, then China then can control the narrative, and they could keep that 125 for a long time, which does impact our exporters into China. But I don't think that's the biggest piece of it. It just makes it really hard for us to get down to 50 or 60% if China's going to stay at 125. I've
Mhm.
been making that point for a while. So I worry from a pure negotiating art of the deal standpoint whether or not that was an idea that would work really well or not. I honestly don't think it would as far as that goes. And the comment about $2 instead of 30, pay a few bucks more. That was over this weekend, and the market dropped, Monday and Tuesday. And to me, the problem with that comment is there's an acknowledgement that number one, there's going to be shortages and it's going to cost more for what you've
Mhm.
got. But the more troubling comment was that to me was just that, ooh, they're thinking about these as permanent tariffs, okay, for the long term. And yes, there'll be some pain to get through that. And then eventually there'll be this prosperity, which is fine. But the market won't like that gap. Okay. Maybe the market's great in a year or 2 years or whatever, as this prosperity kicks in and all these factories start coming up or whatever might happen. But there's this gap. And so that gap is what concerns me because that gap could be a 20% drop or a 50% drop. And so again, that's the type of thing that I kind of look at and think, okay, those comments mean something to me. They mean that they're willing to have higher prices, which means the Federal Reserve is going to have problems. So let's talk about the Federal Reserve. So they met on Tuesday and came out on Wednesday, no rate cut. But the key takeaway from the Federal Reserve, in my opinion, the comments was that they are going to wait for hard data before they make a rate cut. Market should pay attention to that because what that means is that the Federal Reserve is not going to step in early and try to save things as things start to fall apart. They're going to have to let things fall apart as they wait for this hard data. And so the thought process there is that, they can raise rates to try to fight inflation or lower rates to try to help unemployment, right?
Mhm.
They could go one way or another without that hard data, but they're afraid that they might be on the wrong path and making it even worse because this is unprecedented in terms of the data that we'd look at and what might happen. They want to see what the impacts are going to be of these tariffs. And honestly, they actually want to see what the tariffs are going to be, right?
Yeah, you can't make a decision without knowing.
No, and of course it was changing so often there that it makes it difficult. So the Federal Reserve is not going to be there to support the stock market like it might normally because of the tariffs and the uncertainty of tariffs. That's exactly what I got out of the commentary from Chairman Powell on Wednesday. And so, that's not normal. Now they're normally late anyway, so I got
Mhm.
maybe, but this could make them even later. So the bet, um, not that long ago was kind of a 55-60% chance of a rate cut in June. And now that's a 20% chance of a rate cut in June and
Yeah.
80% no rate cut,
Mhm.
right? That's because of these comments and what's happening and the uncertainty that tariffs bring to the table. And so I wouldn't want to be on the Fed board right now. Okay, let's look at some other pieces here. Uh, the uh, the last one, okay, and this should have scared the living daylights out of the stock market, and it didn't. Trump was asked a question about, the ports slowing down
Mhm.
on the West Coast and East Coast and what have you, because China, shipments have dropped approximately 60%. And he said, oh, this is a good thing. And he said, this is a good thing because it means we're no longer losing. And so this fundamental misunderstanding of what a trade deficit is the most dangerous thing that we have going for us at the moment. So he sees zero trade with China as better than having this deficit with China on the trade, where we're buying more than we are selling them.
Mhm.
And there's some parts of this that aren't incorrect. China needs to be a better player on the world's trade market. They're probably one of the worst, in my opinion. Um, but the way that we've gone about it, and I guess that's the biggest problem I have. It, you could solve this really quickly if you came out and said, okay, we're going to do these same things, but we're going to spread it out over a 5-year period to give all these companies a chance to actually, come in and find alternate sources and what have you. And everybody gets a chance. It's the abruptness of all of this that's causing the biggest problems. The stories about these, 46% of toy companies will be out of business in, a couple of months here with these tariff levels. And even if they get down to the 50 or 60%, I bet you the toy companies get hammered. They don't have that kind of margin in toys, and there's not going to be that much demand for toys that cost 50 or 60% more. So, they're going to see a drop down, and that creates unemployment there. And that, again, you get into that unemployment cycle. The Fed probably would step in because they're going to start to see some hard data there on the unemployment cycle potentially. Um, but if you look at the totality, okay, of all of the comments, tweets, and actions, there are some good ones. Matter of fact, there are better ones than there were, let's say, Liberation Day timeframe when the market was really falling apart. Things have improved. We now are talking with China and those types of things. But there are enough other comments, enough other issues, and you're trying to read tea leaves here. It's all we have. And to say to myself, I'd rather, kind of wait it out and see how things are going to go. I'd like to see more positive developments uh, by far than what we're seeing because, misunderstanding trade deficits, having monstrous tariffs, and even moderately low tariffs that you think are going to be permanent, that hasn't worked in the modern global era. All right, it just hasn't worked. And so I don't see how this is going to work, and I struggle with that. And so if you look here, since Inauguration Day, oh, change. Oh, it's changing here, but not there. That's a bummer. Oh, hang on it. Little teleprompter thing here isn't picking it up.
Do you want to switch it to screen? Give me a sec.
All right, we're back. Sorry. Sometimes the laptop here disconnects with our main computer here. This is the S&P 500 since Inauguration Day. When I look at that chart, there's some positives in there. We certainly have come up over that big bump that we had in the pause. We haven't been able to get back to where we were, kind of that higher point after Liberation Day as far as that goes. We've been waffling there a little bit. But overall, that's a downtrend so far. It still is to me. That could change pretty rapidly. All of this could change really rapidly, which makes it difficult. However, when I look at a chart here of this T-bill ETF, which is one of our big holdings now, this is State Street's. This is called the Spider 1 to 3 month T-bill ETF. The ticker symbol is BIL. It's paying 4.3% is the current yield, right? That could be a higher yield than the S&P 500 by the end of this year if we continue to do what we're doing and we don't improve what we're doing. And so again, looking at the totality of all of the comments from this past week, from positive to negative to neutral, and all of the actions that have happened, Federal Reserve, the Treasury Secretary, whoever it is that's out there trying to read into all of these things and study into how these tariffs work and how they've worked in the past, I'm not at a point in time where I want to get off of that train. Okay. And so that's, if you bought at the bottom here, you would have made probably 7-8%, which is a lot more in a very short period of time, which is a lot more here. But we're not traders. It's not what we do. It's actually kind of difficult to do that with big dollar amounts to get everything organized and literally, 1,000 accounts and get everything in and out really fast. We don't do that. And philosophically and just in terms of, how I look at things, I would rather have capital in hand, okay, that happens to miss out on some upturn than having that capital out there that ends up being significantly less at some point in time. And I try to balance. Investing is a betting game. You look at probabilities, and right now the probabilities aren't high enough for the risk that you would take to go from this line to this line. Okay, that's how it works. So I have to have that probability of success has to jump up high enough for me to want to jump off of this T-bill line. And it's just not there yet. So long answer for short question, but no, we haven't increased the exposure to our client stock positions yet. I have clients that might want to, and I'll be happy to do that. It's their money. We will continue to manage it the way that they'd like. But as a blanket, recommendation across the clientele, this is where we're still at. So look forward to being able to, talk to you again some more tomorrow. On Monday when we get going again. And we will not have a show next Friday. I will try to do a summary for what I saw happening in the market, but not the full show. So look forward to talking to you then.